In 2013, a man sold his Shanghai apartment, quit a $390,000 job, and bet everything on a digital coin most people dismissed as a scam. That asymmetry of downside and upside is the hidden mechanism behind every great fortune. This is not a biography, it's a forensic account of why a handful of people consistently capture life-changing wealth while everyone else watches. We'll trace Changpeng Zhao's ascent from rural China to Binance, decode the early returns of Warren Buffett, and map the courage of historical figures who acted when the odds were overwhelmingly in their favor, and those who didn't. The answer lies in a few concepts buried in quantitative finance and evolutionary theory. The core idea is that wealth creation often follows a nonlinear path, where the potential for loss is limited but the potential for gain is enormous. This asymmetry, when properly managed, allows a few to break free from the average. By examining these cases, we can extract the underlying principles that separate the wealthy from the rest. Most people live in what Nassim Taleb calls mediocristan, a world of linear returns, where effort correlates with income, and the difference between the best and the average is modest. Salaries, small business profits, savings accounts, all bound by gravity. Then there is extremistan, where outcomes are winner-take-all. A single platform can serve billions, a single trade can multiply wealth 100-fold. Here, the distribution has no mean, just a tiny elite capturing almost everything. CZ's switch from a stable tech career to cryptocurrency was not reckless, it was a deliberate migration from one statistical universe to another, armed with a safety net that insulated his downside. In mediocristan, the risk of failure is low but the ceiling is low too. In extremistan, the risk of losing everything is high, but the potential reward is astronomical. The key is to have a safety net that allows you to survive the downside while positioning for the upside. Born in rural Jiangsu in 1977, CZ's early life was unremarkable until his father earned a PhD in Canada. As a teenager, he worked at McDonald's and gas stations, baptized by the raw mechanics of money. By his early 20s, he was building financial software for the Tokyo Stock Exchange and later Bloomberg, where his annual pay hit $390,000 in 2000. That was his safety net, a Canadian passport, a Wall Street pedigree, and a skill set so scarce that he could find a six-figure job anywhere instantly. This was not just a career, it was a risk mitigation asset. When he later sold his house to buy Bitcoin, he wasn't gambling. He was deploying capital outside a robust safety perimeter. His human capital and credentials ensured that even if the crypto bet failed, he could rebuild his wealth through high-paying employment. This safety net allowed him to take risks that others couldn't. Before any asymmetric bet, calculate the ratio of your safe assets to the potential loss. CZ's safety net, his human capital and passport, represented a multiple of the Shanghai apartment's value. Mathematically, if S is safe assets and L is the maximum loss, the protection ratio P equals S/L. For CZ, P was far above 1, meaning a total wipeout of his crypto bet wouldn't jeopardize his ability to rebuild. Most people bet when P less than 1, borrowing against their survival. The formula exposes why what looks like courage is often just a well-engineered structure. It also explains why Buffett, with a family safety net and early mentorship, could withstand the volatility of 1950s markets. The protection ratio is a crucial metric. It quantifies how much downside you can absorb without losing your ability to recover. A high P allows you to take risks that would be reckless for others, turning apparent courage into a calculated move. Wealth accumulation faces a constant downward pull. Debt interest, living expenses, taxes, inflation, and unforeseen shocks act like gravitational drag. Most people never lift off because their net accumulation rate never exceeds this drag. The escape condition, annual net savings must exceed the sum of all financial drag components. For CZ, his high income and low lifestyle costs created a surplus that he could redirect into high upside assets. But here's the critical insight, even escaping drag isn't enough to enter extremistan. You need an asymmetric catalyst, a spike in returns that breaks the linear trajectory. That spike only comes from positioning in a mispriced asset or venture. Without such a catalyst, you remain in mediocristan, where returns are proportional to effort. The escape velocity is not just about saving more, it's about redirecting savings into opportunities that have the potential for exponential growth. In June 2017, at a Hotpot dinner in Shanghai, over 100 people told CZ he should launch an initial coin offering. By then, he had spent 4 years immersed in crypto, building exchange technology and studying market microstructure. Others saw a speculative frenzy, CZ saw a closing window. That night, he called his team and gave them 3 days to write a white paper and 2 weeks to raise $15 million. They succeeded, and within 5 months Binance became the world's largest crypto exchange. The overnight success was actually 4 decades of fuel igniting at exactly the right moment. And the technical skill of building an exchange was something he'd already practiced in his Bloomberg days. The Hotpot moment was the catalyst that turned his accumulated skills and capital into a massive asymmetric bet. The window was closing as regulators and competitors moved in, so speed was essential. In evolutionary theory, the Red Queen hypothesis says organisms must constantly adapt just to maintain relative fitness. In finance, the market's collective intelligence advances relentlessly. If you stop learning, your edge decays. The required learning rate L must exceed the market's adaptation rate M, or you fall behind. CZ's frantic execution was driven by the awareness that the ICO window was closing as regulators and competitors caught up. Similarly, Buffett's early edge came from reading Moody's manuals that no one else bothered to analyze, until computers killed that arbitrage. The Red Queen formula quantifies why resting on past knowledge is fatal in extremistan. In a fast-moving environment, the only way to stay ahead is to continuously acquire new skills and insights. The moment you stop learning, your relative advantage erodes, and you become average. In the 1950s, Warren Buffett achieved annual returns of 50% by exploiting a massive gap between intrinsic value and price. The formula is simple: profit equals the difference between intrinsic value, 4, and price, P, multiplied by position size. But why was that gap so wide? Post-war fear, no instant data, and the stigma of stocks left countless companies trading below net cash. Buffett's genius was systematic search. He read the entire Moody's manual twice. His edge was not genius but diligence applied to a market with extreme inefficiency. Today, that gap closes in milliseconds via algorithms. The formula still holds, but the 4P spread has collapsed for large caps. The cognitive arbitrage is about seeing what others misperceive. In the 1950s, the misperception was that stocks were risky. In reality, many were undervalued. Buffett's systematic approach allowed him to profit from that misperception. History shows 3 recurrent patterns where downside is limited and upside is extreme. First, blood in the streets. Panic selling creates prices far below fundamental value, as in 2008 when Lehman collapsed and the Dow fell 777 points in a day. Second, closing cognitive gap. An innovation like Bitcoin is priced as worthless until enough people understand it. Early adopters capture the convergence. Third, macro crisis plus liquidity. A shock like COVID-19 triggers massive money printing, lifting all assets in a re-rating wave. Each has a common signature: the potential loss is capped, you only lose your investment, but the gain is uncapped because fear or ignorance has created a mispricing. These patterns repeat because human psychology remains constant. Fear and greed drive prices away from fundamentals, creating opportunities for those who can see the asymmetry. Marshal Grouchy, a competent and loyal commander, was ordered to pursue the Prussians on the eve of Waterloo. The next morning, as he ate breakfast, the distant thunder of cannon signaled Napoleon's engagement with Wellington. His officers begged him to march toward the gunfire. Grouchy hesitated, citing his orders. By sticking to the rules of mediocristan, he missed the extremistan pivot. His intact army arrived too late, and Napoleon's empire fell. This scene encapsulates the tragedy of doing everything right in an average world and failing when the nonlinear moment arrives. The market, like the battlefield, rewards those who adapt their orders when the smoke signals a change. Grouchy's failure was not incompetence but an inability to recognize that the situation had shifted from a linear pursuit to a nonlinear, winner-take-all battle. In finance, this is akin to sticking to a plan when the market regime changes. Meanwhile, in 1644, the Manchu regent Dorgan faced a similar fog. A desperate general, Wu Sangui, offered to open the pass to Beijing if the Manchus would help him fight the rebel Li Zicheng. The situation was ambiguous. Was it a trap? Dorgan had days to decide. He understood the asymmetry. If he committed his entire army and won, the Qing would conquer China. If he lost, his people would be annihilated. But the downside was already priced in. The Manchus would be destroyed if a unified Chinese dynasty reformed. So he marched 500 miles in a forced march and risked everything. The result, the Qing dynasty. He acted not recklessly, but with an intuitive calculus of risk-reward. Dorgan recognized that the potential upside was so vast that even a high probability of failure was worth the risk, because the alternative was certain decline. At the pivot point, courage is not blind bravery, it is the decision to act when the expected payoff is large and the downside is survivable. Define asymmetry. A equals U times P underscore U, / D times P underscore D, where U is upside gain, D downside loss, P underscore U and P underscore D are subjective probabilities. If A 1, the bet is favorable. But the psychological hurdle is immense, fear of loss is hardwired. This is why the safety net ratio, P, matters, it lowers the perceived D. The stories of CZ, Buffett, Li Xiaolai, and Dorgan all show that high A bets, when layered on top of a high P structure, lead to the extreme outcomes that define fortunes. The formula turns fear into a number. By quantifying the asymmetry, you can override the emotional response and make a rational decision. The key is to ensure that the downside is survivable, so that even if you lose, you can continue. Most of life is garbage time, long stretches where no big windows appear. The real work during these periods is to build fuel, skills, capital, safety nets, and cognitive maps. Li Xiaolai spent $1,000 a month on English books in 2005, buying knowledge arbitrage. Guo Hongkai, a beef seller, built a Bitcoin following through sheer consistency. Both had no elite credentials but maximized their learning rate and networked into the emerging crypto space. When the 2017 wave hit, they were already in position. The lesson: in the boring years, your job is not to force a breakthrough but to prepare so thoroughly that when the cannon sounds, you can march immediately. Preparation involves not just saving money but also acquiring skills and knowledge that will be valuable when the opportunity arises. The key is to be ready to act without hesitation. The line that separates those who break free from those who stay trapped is not talent but the ability to recognize an asymmetric bet and then press the button. CZ, Buffett, and the historical figures we examined all had safety nets that allowed them to act without existential fear. In today's financial landscape, where information travels at the speed of light, pure cognitive gaps are rare, but structural asymmetries still emerge, in distressed debt, frontier technology, or macro revaluations. Your task is to methodically raise your protection ratio and learning rate until an opportunity with a greater than 5 appears. Don't chase noise, conserve energy for that one pitch. The framework is not a guarantee but a guide to thinking about risk and reward in a structured way. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.